Accountants, we can be a frustrating bunch sometimes, right? We usually avoid giving straight answers. However, we are not as bad as lawyers, though. No offense to the lawyers in the room. As accountants, we get asked all sorts of questions ranging from tax, business structures, how to grow a business. And one of the key areas in the growth of your business is around wages and earnings. Specifically, how to earn more money and pay less to the taxman. Can I have a show of hands who would like to draw more money from their business without having to pay too much to the taxman? There you go, pretty much the full room. Whether you're starting your own new business or running your existing business, one of the key questions or frequent questions I get asked is, how do I pay myself from the business? And we would often answer that or respond by saying, well, it depends on various factors, such as, how's your business structured? Is your business going to have a profit or loss this year? And do you have any family members who are in a lower tax bracket or not earning enough from other jobs, if any? Now, the rest of the content of my presentation from this point is sort of technically heavy, so make sure you've had your coffees and candies so that you stay awake. Now, let me give you an example of John, who left his high-profile corporate consulting job and stepped into the business world to start his own management consulting business. John came to us for advice regarding the structure of his business. Now, John was going to pitch for big corporate clients and exposed to risks and liabilities, and we recommended John that he should probably set up his business as a Pty Limited company. John was going to be the only director, and the 100% of his shares in his company was going to be held by a family trust, with John and his wife being the trustees. And John's wife, Emma, was also doing a part-time admin job on the side, earning about $25,000 excluding super. So once John has commenced his business and we had set him up to commence trading, he started billing his customers. John came to us again for further advice regarding how he should now start drawing or paying himself from his business. He was not expecting to have any employee in the first year as he builds his business. So we asked John a series of questions, and he provided us a few facts. Now, I've got the rest of my presentation, got a lot of numbers I need to go through, so I'll just have to refer my notes, and I'll stay close to the lectern so that I can place my notes. So let's look at some of the facts John provided us. So he was expecting to have your first year estimated revenue somewhere between 150 to 200 grand. And the expenses of his business would be around $50,000, excluding any salary to John. And John's wife, Emma, was going to do some admin and marketing work on a part-time basis in the business. John wanted to draw a salary of $10,000 per month, or equivalent to $120,000 per annum, plus super from his business. So we explained a few different scenarios to John. In the first scenario, John sets himself up on a payroll to draw a wage of $10,000 per month. John will pay tax on his wages, which the company will deduct in the form of PAYG and pay that to the ATO, and the company will pay superannuation of 10% on top of his wages. So let's look at how the numbers look in the first scenario. So his revenue, let's say, finishes at about $150,000. His business expenses was $50,000. John's salary $120, and John's super of $12,000. Emma's salary of $20,000, and Emma's super $2,000, and his total cost for that year was $204,000. So obviously, John ended up with a loss of $54,000 in his company. And in this case, let's say we assume that the loss in the first year in the company is funded by unpaid creditors or the initial loan or capital that John contributed out of his savings. So John's cash in hand was $7,000 per month after paying the tax on his salary. Now, in this case, John has already paid $36,000 tax on his salary of $120,000. The company's loss of $54,000 cannot be now offset against John's salary income. So in this scenario, we estimate that John has paid about $15,000 more in tax. And you'll see that when we do a comparative scenario. So in the second scenario, we asked John to reduce his salary to $60,000. So let's assume the revenue and the other expenses of the business remain the same. Now, John needed $7,000 cash in hand after tax to meet his mortgage repayment, school fees, family expenses. So with $60,000 or $5,000 a month after tax, John will get about $3,500 in hand. So we suggested John to start drawing additional $3,500 from the business in the form of director's loan. So with the rest of the expenses remaining the same, his total cost will be $138,000, and he'll make a profit of $12,000 in the company. John will pay $3,000 approximately tax on that $12,000 profit on the company. His cash flow would remain the same. He would have paid $18,000 on his salary income of $60,000, and he would have saved roughly $15,000 in tax, as he paid combined tax of $18,000 plus $3,000, about $21,000 against $36,000, and his cash flow remains the same. So in this particular scenario, we have assumed that John passes the personal services income test, which is one of the tests in the tax legislation, where he has to meet certain tests to qualify as a personal services business so that his income doesn't need to be fully attributed to himself, and he can split the income with his family members. Now, we gave a third scenario to John, where if John was going to run his business as a family trust instead of a company. In this instance, we suggested that John doesn't need to draw any salary from his business, from the family trust, and he doesn't need to pay any salary to Emma as well, his wife. John can just draw $7,000 a month from his business as owner's drawings from his family trust. Now, in this instance, with the revenue being the same and the remaining expenses being the same, and no salary and superannuation to John and Emma, he would have made a profit of $100,000. Now, in a family trust, this profit needs to be distributed to the beneficiaries because the family trust doesn't pay tax on its profit compared to the company. So we would recommend the distribution of the profits as follows. First of all, we give Emma a profit distribution of $20,000 as she's earning a salary income of $25,000 from her other wages. And with her total $45,000 salary, she would remain in a 19% tax bracket. And the remaining $80,000 can be distributed to John, and he still has an option to contribute $25,000 to super and reduce further his taxable income to $55,000. And in this instance, both of them will be able to achieve the optimum tax outcome and potentially pay the tax in the lowest tax bracket. Now, Using these different scenarios, case study of John and the alternate scenarios we looked at, I would like to draw 3 important considerations. Number 1, what is the role of the business structure in deciding how do you pay yourself? Number 2, to identify considerations with the director's loans or drawings. And number 3, would the situation change if you have unrelated partners in your business? So to do this, let's first look at the business structure and the consideration with the director's loans or the owner's wages. Now, each business structure has a different legal and tax consequences, and based on the legal status of a particular business structure, you could achieve a different tax outcome. And I'll go through that in a little bit more detail, but before that, we'll just go through a quick quiz question. So which business structure do you use for your business here in the room? You've got 4 options. You're a sole trader, you're a partnership, you're a trust, or a company. Please have your clickers and you'll have 10 seconds to answer. 47% companies. That's half of the room probably running the business as a company. All right. So for each of the business structure, I'm going to have two main points which I've identified for us for the understanding perspective. And also, for the purpose of the rest of the presentation, I'm just going to address the business owners as her. So let's look at the first business structure. The 2 points I'm going to identify would be how do you pay yourself in that particular business structure, which we will discuss. And the second one is the associated problem with the owner's drawings or the loans under that particular structure. So we'll start with the first business structure, which is the sole trader. Now, in case of a sole trader, the business is not treated as distinct from the actual business owner. So whatever the business owner makes is treated as her income. So the business owner can't really pay a salary to herself because whatever the business owner is going to draw from the business to pay herself is going to come out of their sole profits and will be taxed in their name personally. So what is the associated problem with the owner's drawings in case of a sole trader? Since there is no legal separation between the business and the business owner, everything that is deposited or withdrawn goes through the capital account of the business owner, so it doesn't give rise to any loan accounts in the business with the business owner. So the second structure is a partnership. So the first point is that how do you pay yourself in a partnership? Now, partnership is also not a separate legal entity, and partnership also doesn't get, or it's not a taxable entity as well, but it has to lodge its tax return after the end of the financial year, but partners are taxed on the share of the profits of the partnership. So the partnership cannot claim a deduction for the salary paid to the partners. But the partners still have an option to allocate an unequal salary to the partners to achieve a different or vary the distribution of their profits in the partnership amongst them at the end of the year compared to what their normal ratio is. So, in other words, partnership salary is not truly a salary, but is an actual sort of distribution of the profits of the partnership itself to the partners, but the salary is used as a vehicle just to vary the entitlement to the profits different from their normal share of the partnership ratio. Is everyone with me? All right, great. Now, I would demonstrate this partnership by a simple example. So, in this example, Anna and Robert, they formed a partnership under which they agreed that they'll share the profit and losses of the partnership equally 50-50. The partnership agreement allowed the partners to draw a salary if the partners so agreed. So at the beginning of the income year, they agreed that Anna would draw a salary of $20,000 for managing the business, and the balance of the profits they will share equally. So the 2020-21 year net profit after paying Anna's salary was $35,000. So they had a revenue of 55, they paid Anna's salary of 20 grand, and they had $35,000 profit after deducting the salary. Now, for the purpose of determining the net income for distribution purposes that will go on the tax return of the partnership, we add back Anna's salary again to determine what was the profit before her salary, which was $55,000, and then we will allocate the profits in a distribution statement, which would be, we allocate first $20,000 towards Anna's salary as the first part of the profit distribution, and then the remaining $35,000 is divided into 50% each, so she gets $17,500. So her total distribution is $37,500, and Robert gets the remaining 50% of the profits of 35, so he gets 17,500. So you can see in a normal scenario, if their profits were distributed 50% each in their normal ratio, they would have got a profit distribution of 27.5 each, whereas by allocating a salary, you could achieve an unequal or a varied distribution of profits, which you normally can do if you want to change the tax outcome for a particular partner. So what could be an associated problem with owner's drawings or loans in case of a partnership? It's very similar to a sole trader scenario. So any deposits or withdrawn is transacted through the partner's capital account, and it doesn't really give rise to any loan accounts. The partner's capital account can be negative if they overdraw, but it doesn't really result in a loan account. We'll look at the third structure, which is a company. Now, first of all, how do you pay yourself from a company? And we've seen 50% of the room is operating as a company. So as we've seen in John's case study at the beginning, any salary which gets paid to the directors is taxed in their name personally at their personal marginal tax rates, and that's irrespective of whether the company has made a profit or a loss. Now, what is a problem with directors' owner's drawings or the loans in case of a company? So if the directors or shareholders draw money from the company other than in the form of their salary or dividends, it results in a loan or a director's loan account, and that could be a little bit complex to handle. And there are a few reasons for that. First of all, now the business owners want to utilize a lower tax rate available for a company, but they still want to draw more funds from the company for the purpose of their personal use or investments outside the company. So if they try to draw those funds in the form of an additional salary or dividends, they again will be taxed at higher marginal tax rates, depending on what their personal marginal tax rates are. So often what happens, the business owners will then draw the additional funds in the form of director's loan for that to be offset against the future dividends they will draw. Now, under the tax law, there are some limitations on how the directors can draw loans from a company, and this is regulated under Division 7A of the Income Tax Administration Act 1936, and is typically or commonly known as Div 7A loans, which you might be familiar with. Now, under the Division 7A loans, you have to put these loans under a formal loan agreement before the due date of the tax return of the company has to be filed. And you need to repay those loans back to the company within 7 years, along with the interest on those loans, which is at a benchmarking rate of interest determined by the ATO. And this interest on these loans is typically not tax deductible to the shareholders. So if you don't follow this process under the Div 7A loans, the entire loan which the shareholder or director would have drawn out of the company would be taxed as unfranked dividend in the hands of the shareholders, which means all the associated franking credits or the tax credits which are attached to the dividends in the company are not available to be claimed by those shareholders in their personal name. It's very easy to get caught in these Div 7A loans cycles, because if the business is making profit every year and you create new Div 7A loans every year by additional withdrawals, and you don't get an opportunity to wind down these Div 7A loans in a timely manner. I hope everyone is still with me. All right, I said it's technical. So just to make sure that we keep you all awake, I'll go to a quick quiz question. Do you think you have a Div 7A loan problem in your business, especially 50% of the room who answered were running the business in a company structure? The options are yes, no, or we don't know what beast this Div 7A loan is. So if you have your clickers, you'll have 10 seconds to answer, and your time starts now. Ooh. 70% of the people, I presume those who have answered are running a business as a company, are not aware of this bomb sitting on their balance sheet. So you need to talk to your accountant. All right. The last structure is a trust. Now, trust is a separate legal entity as well, similar to a company. So how do you pay yourself from a trust? Any wages taken by the owner is taxed separately, irrespective of, again, the trust ends up in a profit or a loss. It's very similar to a company. The only difference is that the company is taxed on its profits after it has paid wages to the director, whereas in case of a trust, the remaining profits after paying a wage to the owner has to be distributed to the beneficiaries of the trust. The trust doesn't pay tax on it, and the beneficiaries have to pay tax on those profits as well on top of their wages. So what's a potential problem with the director's loan or drawings in case of a trust? Now, trust is a very flexible structure, and that's why it's often used in comparison to the company. Now, the trust don't pay tax on its profit compared to a company. So it does not, and the beneficiaries have to pay the tax, as I mentioned. It does not have the same, or does not enjoy the same lower tax environment, because the profits have to be distributed to the beneficiaries and they have to pay the tax. So often it doesn't, I mean, the business owner, if they draw more money on top of the salary from the trust, even though it is classified as loan, does not have the same strict regulations or issues like a Div 7A loan problem in a company. The only exception is when a trust will distribute profits to a bucket company, which you would have often seen. Other than the actual beneficiaries, it could give rise to Div 7A problems. So just quickly, the third point, which I mentioned earlier, working with unrelated partners in the business. Now, we've seen in some of the above scenarios with the different business structures that how can you play with your salary or dividends or director's loan to achieve an optimum tax outcome. And it could behave differently if the business is run as a family business or if there are unrelated partners in the business. It's easy to manage these scenarios when it's a family business, because the profits and the funds have to ultimately flow to the same family. So having a salary which is not commensurate with the efforts and skills of the partners is not a problem, because you can ultimately restructure the overall drawing from the business to achieve your desired outcome. But it may not work if you have unrelated partners in the business or directors who are contributing their time and skills in a different ratio. So generally in that case, it's recommended to have a market salary structure. Now, as business owners, we all want to achieve an optimum tax outcome. And it's a matter of effective tax planning to achieve this objective in a legitimate way within the boundaries of the law. And it's not a crime to be smart, to utilize various flexibilities available under the law to minimize your tax. But I would recommend to keep in three high-level principles in mind. Number one, make sure that you decide your business structure after a detailed discussion with your accountant with some future planning in mind. So if not structured right in the first place, it could be a costly exercise to change your business structure. However, it's not impossible. You just need to do a cost-benefit analysis. Sometimes the business could grow beyond your original expectations, and the circumstances can change, which can require a revaluation of your business structure. However, within your existing business structure, you could still achieve a different tax outcome each year, depending on your circumstances or the results of your business. So it's important that you do tax planning each year before the end of the financial year with your accountant to make sure you've taken each step possible to minimize your tax. And third, sometimes a short-term tax saving can result in more complicated situation in the future. For example, the Div 7A loan I explained could just be a tax deferring exercise, so you should adopt that with caution to make sure it's going to help you overall in the long run. So John and Emma didn't realize the nuances of running their own business when they left their corporate job and stepped into the business world, and the associated accounting and tax issues. So we helped them along their business journey and guided them to adopt the right accounting procedures, maintain proper records, ensure compliance with the ATO. So this helped them to be aware of what's going on their business and had enough time so that they can discuss with us the results, the periodical results of their business, and any changes to be incorporated to achieve the optimum tax and cash flow outcome in their business. Now they, by having the right discipline in maintaining the accounts and taking timely advice, helped John and Emma to grow and scale their business. See, accountants will always be accountants. I mean, we might not give you a straight answer, but not all of us are same. Some of us will provide a solution to your specific problem. And so make sure you take the timely advice. Thank you.